Okay. So good afternoon, everyone. I want to believe that you can hear me clearly. So we can start our class now. Again, you're welcome to Equity Professionals. And you're welcome to Financial Reporting class. Today will be our class 3. And today we'll be moving on to ethics in reporting, as well as we'll also look at technology in reporting. We'll look at ethics in reporting and technology in reporting. Then, maybe later on in our next class, I would jump to analysis and interpretation of financial statements. Then afterwards, I will move to EPS. Then before we move to accounting standards, and I might be asking you to join a class during the week in the evening for sustainability reporting and IFRS 18. If you join that, that will give us a little leverage because we will have taken advantage of some extra time, which is very good for us. So let's see how far we can go in this, our first period for today. So last week, we started and finished up conceptual framework. And I can remember clearly that I told you that conceptual framework is majorly about the set of principles that are used in developing IFRS. Remember in our class 1, we established that IFRS are principle-based reporting. They are principle-based, meaning that they are developed from set of principles. Those set of principles on which IFRS is developed is known as conceptual framework. And we learned that last week. We looked at the 8 chapters of the conceptual framework, from chapter 1 that talks about the objectives of a general purpose financial report, to chapter 2 that talks about qualitative characteristics of a useful financial report, to chapter 3 that talks about financial statements and the reporting entity, chapter 4 that talks about elements of financial statements, to recognition and derecognition, to measurement, presentation, and disclosure, as well as concept of capital and capital maintenance. We looked at the objective of a general purpose financial report, and we saw that the objective is to provide financial information about a reporting entity that is useful to existing and potential investors, lenders, and other creditors to enable them make decision about providing resources to an entity. We mentioned that the keyword here is that the objective is to provide financial information. We looked at those set of financial information that we provide to users. We said they are the economic resources of an entity, which are the assets of the entity. We have claims against the economic resources, which are the liabilities. And also, we said there are the changes in claims and economic resources, which are majorly income and expenses. Then we went ahead to look at that this information, when we present it to the users, and they should be provided on an accrual basis. that we should provide this information on an accrual basis. And accrual basis of accounting means that all transaction of an entity should be captured, whether or not there is an exchange of cash. Make sure you capture all transactions. By doing so, we are going to be presenting information about all the economic activities of an entity. We will not omit anything. By the time you're capturing all transactions, you're not just focusing on cash, all of it. As soon as the transaction occurs, document it, capture it. That's accrual basis. You capture is an economic representation of an entity's activities. That objective also talks about the primary users, who are the potential and existing investors, lenders, and other creditors. And this set of guys majorly need this information to make decision. The investors will want to make decision on whether they should buy or sell the shares of an entity. The lenders want to make decision on whether they should provide additional credit to the entity. The other creditors will want to make decision on whether they should provide additional trade credit to the entity. So the lenders are like the banks, people that borrow the company money. But other creditors are majorly suppliers, people that sell to us on credit. We moved on to the qualitative characteristics of a useful report. We looked at fundamental and enhancing. We said the fundamental characteristics are two: relevance and faithful representation. We said the enhancing characteristics are four: comparability, verifiability, we have timeliness, and we have understandability. And we explained the two. We mentioned that relevance is what makes the information make a difference in the decision made by user. And the information is capable of making a difference if it has predictive value and confirmatory value. And I give you examples of what you find in information that makes it have predictive value. Talked about providing comparative information, providing diluted EPS, and providing information on discontinued operations. And I talked about that when we talk about relevance, materiality is very important. And we also explained faithful representation as well. For the enhancing characteristics, those ones are quite straightforward. We have comparability, which means that you should be able to compare the financial report with other entities' report and even your own report of previous year. We have verifiability. Independent observers or independent professionals should be able to recheck or recalculate your figures. That goes to show that we need to provide sufficient information about our figures so that professionals can recalculate whatever it is that we have done. Then there's timeliness, in that we need to provide this information as at when needed. And there is understandability, which means that the report should be easy and concise, that a user that has reasonable business and accounting knowledge should be able to understand that report. If he cannot, then that means it is not understandable. Then we moved on to chapter 3 that talks about financial statement and the reporting entity. We explain all that. Then we moved on to chapter 4 where we defined elements of financial report from assets, liabilities, equity, income, and expenses. We moved on to chapter 5, where we explained recognition and the recognition. Then chapter 6, where we talked about measurement of elements of financial statements. We explained all the measurement bases that we have. Then we moved on to chapter 7 on presentation and disclosure. And we ended it with chapter 8 that talks about concept of capital and capital maintenance, which we'll explain. Now, before we move on to what we have for today, I told you you need to look at some corrections and which are your past questions majorly. I told you that something that comes out commonly in your exam. So if you look at this question, it talks about, it says, this was in 2020. It says the regulatory body responsible for issuing accounting standards in accordance with local and international regulation in Nigeria is the Financial Reporting Council of Nigeria. Required. Briefly explain three main objectives of setting up the Financial Reporting Council of Nigeria, and explain two identical issues in financial reporting which companies may be sanctioned for by this body. Okay, so I have talked about this before. I already told you the objectives of the FRCN. Can we contribute to this? Is there anybody, can you give me point on this?
To protect the interest of investors and shareholders.
Correct. That's the most important one. Number two.
To ensure that good corporate governance practices is adopted by entities.
That's also correct. Number three.
To harmonize the activities of professional bodies like ICAN, CITAN, and all the rest.
That's also correct. Okay, good. So they now said we should identify two ethical issues in financial reporting which companies may be sanctioned for. Two ethical issues in financial reporting which companies may be sanctioned for. Can you remember this? There are many. Number one, a failure of a professional to register with FRCN, failure of a company to register with FRCN, failure of a company to comply with IFRS, failure of a company to submit its financial statements with FRCN, failure to allow field auditors, like people that come to do audit, failure to allow them to have access to the company's premises and records, or allowing professionals that are not registered with FRCN to have an input into the financial report. So I painted these pictures to you. So if a company does not do this, it's an ethical issue. An FRCN can sanction such a company. Okay, that's for 10 marks. Now, another one, which is in November 2020, it says non-accounting professionals usually wonder why an entity general purpose financial report should be regulated without allowing users to be free from choice of presentation In order to give clarity on this subject to the non-accounting professional in your workplace, you are required to explain 4 reasons why financial reporting should be regulated in Nigeria, identify and explain 2 sources of accounting regulation, highlight 3 objectives of IASB. So, 4 reasons why financial reporting should be regulated. I think I gave you this as assignments. For those that are in class, a lot of you are in class anyways. What are the reasons why financial reporting should be regulated? Okay, number
It's
one, without, okay, let me say one, then you tell me the remaining. Without regulation, there will not be a way for FRCN to enforce compliance with IFRS. So I've said one, without regulation, there's no way we can enforce compliance. Okay, number two, you guys can tell me.
it helps entity adopt similar accounting method.
That's correct. It helps entity adopt similar accounting methods. That's correct. Any other points?
It promotes transparency and accountability.
Yes, that's correct. It promotes transparency and accountability because when there is regulation, so you would know that you cannot do things that are wrong. So you want to be, it makes you transparent and you know that you have to be accountable. So I agree with you. We need one more point.
Hello, sir.
Yeah.
Regulation ensures that the end users of financial statements are provided with reliable financial statement for their decision making.
That's correct. That's very correct. Because with regulation, the report that comes out will be credible. So becomes to a large extent reliable. Okay, that's correct. So B, it says identify and explain 2 sources of accounting regulations in Nigeria. What are the 2 sources of accounting regulations in Nigeria? Anybody? 2 sources of accounting regulation in Nigeria.
Accounting standard and listing rules.
That's correct. That's correct. Accounting standard and listing rules or stock exchange, local stock exchange listing requirements. Okay, I actually gave you 3. What was the third one?
Company law.
Company law, correct. Company law. Okay, so number 3 says that you should highlight 3 objectives of the ISB. So, what are the objective of the International Accounting Standard Board? Did you mention this?
Formulation of accounting standards.
Okay. That's the only one you know? Mm. So, you see, I gave you the objectives. I gave you 4 objectives of the IFRS Foundation. And I explained to you in the last class that this objective of the IFRS Foundation is also the objective of the IASB. I gave you 4. Number 1, I said to develop a single high-quality accounting standard in public interest. Number 2, I said to promote the use and rigorous application of this accounting standard. Number 3, to take care of the needs of SMEs and emerging economies. Number 4, to harmonize and converge international accounting regulations. And that will be the answer here. That will be the answer. Number 3, they said IFRS may either be premised on principle or rule-based concepts. You are required to explain the principle and rule-based concepts, and B, highlight the 3 basic steps or processes necessary for developing a new accounting standard. So I explained this to you in class, principle and rule-based concepts. So a principle-based concepts are concepts where you are provided with a general guide and you're required to use your professional judgment to implement the concepts, and it allows you for flexibility and it allows you for reasoning. An example of a principle-based concept are IFRS. And a rule-based concept are one in which that is usually written and very strict, and it assumes that you have deep understanding of the rules and which it has to be followed strictly. And examples of rule-based concepts are company laws and local stock exchange listing requirements, and some accounting standard in some other countries like the US.
US.
And now they say you should highlight 3 basic steps or processes necessary for developing a new accounting standard. Step 1, I told you about agenda consultation, where we would identify accounting problems and document them in a work plan. Step 2, I talked about research program, where we would identify whether those problems actually exist and whether we can provide solutions for them. And all these findings will be documented in a discussion paper, which we are going to send out to the public for opinions and comments. Step 3, standard setting program. This is where the board will issue a proposal for an accounting standard known as an exposure draft, which will be sent out to the public for opinions and comments. And finally, they will issue out accounting standard, which is the IFRS. And also, there's a step 4, which is the post-implementation review, where they review the compliance with this IFRS. Another question, they said the Financial Reporting Council of Nigeria is a federal government's parastatal under the supervision of the Federal Ministry of Industry, Trade and Investment. Required, identify 4 main objectives of the FRCN as defined in the Act establishing the institution. We have done this one before because they have asked it in another diet, which we have looked at. Now, another set of questions. You know that all these we are looking at are your past questions, actually. They said the conceptual framework specifies the fundamental reasons why financial statements are produced worldwide, which is to satisfy the requirement of external users required. Outline 5 types of economic decisions for which financial statements are likely to be used, and identify 2 advantages of conceptual framework. So what are the 5 types of economic decision for which financial statements can be used? Number 1, to determine whether to buy or sell the shares of a company, to determine how to vote during an annual general meeting, to determine whether to borrow the company more money or to start a process in which they can recover their past borrowings, to make decision about whether they should provide additional trade credit to the company, to determine whether the company is liquid and would be able to pay interest as and when due, and also to determine whether the company is efficient in the utilization of the resources provided to them. Also, we are asked to identify two advantages of the conceptual framework. Number one, we said it ensures that the development of IFRS is consistent and coherent. Number two, it makes users understand that financial reporting came up from a common ideology, and also it helps in the treatment of unusual transactions. It helps in the treatment of unusual transactions. Another one, it said in Nigeria, financial statements are reported in more detail in both words and numbers. Following the introduction of IFRS, you are required to explain the following qualitative characteristics of financial statements reported under IFRS and assess how they make the information very useful. So, relevance, comparability, understandability, faithful representation for 6 marks. For 6 marks. So, how are we going to explain this now? How do you explain relevance? If you remember, relevance, a report is relevant if it is capable of making a difference in the decision that is made by user, and it is capable of making a difference if it has predictive value and confirmatory value. And for an item to be relevant, it needs to be material. Comparability means that we should be able to compare our financial reports for this year with that of the previous year and with that of other entities' reports, even in the same industry. And understandability means that the report should be simple and concise for users to read and understand. And users are people with reasonable business and accounting knowledge. Faithful representation means that the report should present what it purports to represent, and it must be complete, neutral, and free from errors. Complete, neutral, and free from errors. And that's that. Another one. It said the ISB framework for preparation and presentation of financial statements requires financial statements to be prepared on the basis that they comply with certain accounting concepts and underlying assumptions. Required, explain the meaning of each of the following concepts and use the underlying assumptions Number one, going concern. Number two, substance over form. Is there anybody that can? I need somebody to talk about going concern. That's the way I explained it to you.
Going concern concept states that a financial statement should be prepared with the assumption that it will operate continuously. It will operate till the future foreseeable period.
That's very correct. So financial reports should be prepared on the assumption that a company will continue to operate into the foreseeable future and it does not have any plan to liquidate in the future. It doesn't have any plan to shut down the business. That's correct. Nice one, Eko. What about substance over form?
So, substance over form simply means that financial transaction should be recognized based on their economic reality, not their legal substance. Hello, sir.
Yeah, I'm with you. Is that all?
Yes, sir.
Okay, you tried. You tried. Just that it's not clear. It's just as if you are repeating the phrase itself. So for a substance over form, you'll be required to give some examples just for it to be clearer.
Okay, let me give further examples, sir. Like
Oh,
in terms of lease,
good.
in terms of lease, like financial lease, where the entity takes the reward and risk of the asset. So in entering it in the financial statement it should reflect that the entity is in control of the asset.
Okay, that's a good try, Joseph. That's a good try, very good try. Is there any other person that can put more words to substance over form? Any other trial?
Yeah, that assumption states that an asset should be recognized in its financial existence and not based on ownership or legal existence. Like he used example of leases. It's the financial control or existence of the lease asset that should be considered in the financial statement, not the ownership, not the legal ownership. That is the little I can try regarding that. Over.
Okay, good. Good idea. Let me just emphasize let me just throw more light to it again. So, as Joseph and Akko have mentioned, you need to also know that when we say substance over form, the full meaning is actually economic substance over legal form. Economic substance over legal form. So usually every transaction has both economic substance and legal form. Every transaction. There's no transaction you consummate is will have both. And usually they are usually consistent with one another. That is in such a way that the economic substance and the legal form are always the same. Just like when you go and buy goods from people, if you make purchases, they will give you documentation and all of that you have bought goods. That's the legal form says that you have bought goods, and they will transfer the goods to you. The economic substance also says that okay, you have bought goods. You see, legal form is clear. That's the exist what the contract is saying, what the two of you have agreed. That's legal form. But when we say economic substance, we are talking about the financial reality. We are talking about the economic reality. We are talking about who is incurring expense. We are talking about who is generating income. We are talking about who is using an asset. We are talking about who has an obligation, depending on the transaction. That's the economic substance. Who is spending money? Who is making money? Who, who is paying for this asset? Who is using these assets? Depending on the transaction. And in most transactions, they are usually consistent. Transaction regarding you bought an asset, you sold goods, you bought goods, you paid. I mean, they are consistent. The usage is always the same thing as who owns it. But when we have some transactions where the economic substance, which is the economic and financial reality, where it is not the same as the legal form, and that's what this concept is saying, that in such cases, you should report your transaction based on the economic substance, not the legal form. That's why we said substance over form. So, and they rightly give example of leases. So lease is an example of situations where legal form and substance are not the same. Because when you look at lease, you'd rent an asset, but the asset is not your own. So the legal form is that the asset is not your own. But the economic reality of that transaction is that you are the one using these assets. So we will not record the asset based on legal form. Yes, legally it's not your own, but based on economic reality, when you look at the definition of an asset, you control these assets, you are using it. So the financial reality is that this asset is making money for you, is your economic resources. So you recognize that asset in your books because that's the substance. That's the reality. You are the one making money from these assets. Another example is if you sold goods to somebody and you agree with that person to buy back the goods. Listen again, you sold goods to somebody. If you had stopped there, then the economic substance and the legal form are the same. Because the legal form is that you have entered the agreement to sell, fine. And you have actually transferred ownership and control of that goods to that person. So you have sold, you should recognize revenue. So substance, the financial reality is that you have sold, and which is documented, which is the legal form. But if you guys now go further and you're now agreeing with that person and say that I will buy these goods from you back in the next few months. I will buy this good back from you in the next few months. In that case, yes, the legal form is saying you have sold because there is a contract to show that I have sold goods to him. Legal form, you say recognize sales. The legal form does not look at you buying, but the economic reality, the substance of that transaction is that as it is today, you have an obligation to deliver cash. And that's the liability. The liability, if you remember, I said is a present obligation to transfer economic resources. So the economic reality right now, you have not transferred control of that asset. You have only transferred possession. You have only transferred ownership. You haven't transferred control because you have agreed with that person that you're going to buy it back from that person at a specific price, at a specific date. So the substance is not that of sales. The substance of that sales is that you have borrowed money. You have borrowed money and you are going to pay back because you have a present obligation to deliver cash. You told the person, I will buy it back from you. I will pay you money. And you have agreed. So the substance is that you have you recognize that as a liability, not as a sales. So those are majorly the popular examples that we have for substance over form. And when it comes to substance over form, it's very critical. In fact, you cannot faithfully represent if transactions are not recognized based on their substance. And we expect the legal form to be the same as the substance. If it is not the same, go with the legal form. I think we need, in other classes, I have somebody that reads for me, just so that it's a little more interesting. I think we need somebody that can be reading all these questions, because we'll be solving a lot of past questions. So who would volunteer to be reading for us? We can have more than one person, so that if the person is not around or something like that, another person can take it up. Who is volunteering? Shidewa, are you there?
Yes, sir.
Okay. You and Temitope will be reading. Please read this question. Question 4.
Okay. X Limited commenced business on 1st January with a single item of inventory which cost 10,000 naira. During the year, it sold the item for 14,000 naira cash. During the year, general inflation was 5%, but the inflation specific to the item was 10%. Required, calculate the profit in each of the capital maintenance concepts. Financial capital maintenance. We have financial capital maintenance,
I already did the
physical
solution.
capital.
No worry, it's the
So,
solution you are reading.
okay.
Yeah. So, no, wala. So, I taught you about capital maintenance under chapter 8. So, there's financial, there's physical. Financial, that one deals with money capital. When your opening capital is higher than your closing capital, then you have made profits. But fiscal capital maintenance, that one looks at your productive capacity, in terms of what you can produce, right? What your capital can actually produce. So the real meaning of that is what this question wants to address. That calculate profit under each capital maintenance. You see, for financial, it does not consider inflation at all. And that is why profit for financial, it says you made a sales. You sold an item for 14,000. It records the sales as 14. Its cost is historical cost, which is how much you bought your inventory. And it says you have made a profit of 4,000. And that's it. That's it. But physical capital maintenance, that one looks at your purchasing power. It considers your productive capacity. It considers what that your money can buy today. So if you say you sold an item for 14,000 and you say you bought it for 10,000, right? This guy will ask you, this item that you bought for 10,000 at the beginning of the year, can you still buy for 10,000 today? The answer is no, because there was inflation. So general inflation is 5%, but the inflation specific to the item is 10%. So you use the inflation specific to the item, not the general, because we are considering whether you can buy the item back. So the price of the item has increased by 10%. So you need to consider that as part of your costs, so that you will not be spending your capital. So you do 10% of the cost, which is 10,000, which of 10,000, it gives you 1,000. So that means your cost is 11,000, not 10,000 as recognized under financial capital maintenance. So under fiscal capital maintenance, it says your profit is 3,000, which makes sense. Because this financial capital maintenance now that he's saying he has made a profit of 4,000, imagine if he shares the whole of the profits to his shareholders as dividend. if he shares the whole of the profit, do you know that he will be left with only 10,000? And that 10,000, can he buy the same quantity of goods he bought before? No, no, because there's inflation. But physical capital maintenance has made allowance for that. It has shown you the actual profits, ex inflation. So you can distribute 3,000, give shareholders. You still have 11K, your costs, which can buy the quantity you bought at the beginning. So you are still at the same level you were. And that's what we call capital maintenance, maintaining your capital. Don't lose your capital. Lose it. Okay? Can you read question 5? Can I read it? I see the other guy is not answering.
Okay. Question 5. The ISB conceptual framework for financial reporting gives much detail about the qualitative characteristics of financial statements which make them useful. Required. Discuss the qualitative characteristics which make information useful to users of financial statements. 10 marks. B. The conceptual framework of ISV states that there are two concepts of capital maintenance. Required. Explain the term financial capital maintenance and physical capital maintenance concepts. 3 marks.
Okay, so this is also straightforward. We already talked about the qualitative characteristics. So this one, you are supposed to explain everything. We talk about the fundamental characteristics that includes relevance and faithful representation. You explain that. You talk about enhancing characteristics that includes comparability, verifiability, understandability, and timeliness. You explain those four. Then that gives you 10 marks. Then you explain the term financial capital maintenance and physical capital maintenance. This one, you maintain your capital when your closing capital at the beginning is higher than your opening capital. When your closing capital is higher than your opening capital, and physical capital maintenance is where your productive capacity at the end is higher than your productive capacity at the beginning, and it considers capital maintenance from number of units, your ability to maintain your purchasing power at the end of the year, at the end of the year. Okay, so, okay. Now, if you look at this question, it says, and explain why it is important that financial statements should reflect the substance of the underlying transaction and describe the features that may indicate that the substance of a transaction may be different from its legal form. Yeah, so this is a question going deeper into substance over form. So the reason why it is important for financial statement to reflect its substance is that if financial statement does not reflect its substance, you cannot faithfully represent. Okay, so you would be presenting the substance. It's important to present their substance because that is where you would have presented a complete information. And that is where your information is neutral and most likely will be free from error. So substance over form ensures that you faithfully represent. That's majorly why it is important. And features that indicate that the substance is different from legal form is where ownership is different from control, right? Where ownership of an asset is different from who has control of the asset, or where there is an option to repurchase an asset. When you have options in a contract, where there is like the one I gave you, like the example I gave you, you sold and you now entered into an option to repurchase. You entered into an agreement to repurchase. So when there is an option in a transaction, there is most likely a feature that shows that the substance will be different from the legal form. And this will earn us another 5 marks. Okay. You look at this question 7. This one says, what sales activities include the production of maturing products, which take a long time before they are ready to retail. Details of one such product are that on 1st April 2009, it had a cost of 5 million naira and a fair value of 7 million naira. The product will not be ready for retail sale until 31st March 2012. On 1st April 2009, Wasiu entered into an agreement to sell the product to Easy Finance for 6 million. The agreement gave Wasiu the right to repurchase the product at any time up to 31st March 2012 at a fixed price of 7,986,000, at which date Wasiu expected the product to retail for 10 million. The compound interest Wasiu would have to pay on the 3-year loan of 6 million would be year 1, 1.6, year 2, 660, year 3, 726. This interest is equivalent to the return required by Easy Finance assuming the above figures prove to be accurate. Prepare extracts from the income statement of Wasiu for the 3 years to 31st March 2012 in respect of the above transaction, reflecting the legal form of the transaction. Number 2, reflecting the substance of the transaction. Note, statement of financial position are not required. The following marks is provided as guidance for this requirement: 1, 2 marks, 3. Okay, let's look at this question again so that we can understand what they're talking about. Because a lot of people will sweat on this question. It's quite easy. It's also talking about substance over form. So this is looking at Wasiu's activities. Says it includes production of maturing products, which takes a long time before they are ready. So that means the type of product Wasiu deals with is not something he produces and is ready for sale. No, it takes time before they are ready for him to sell. You now say that one of such products on April 2009 had a cost of 5 million and a fair value of 7 million. Fair value here means selling price. It says that the product will not be ready for retail until 2012, meaning you cannot sell it until after 3 years, 10, 11, 12, 2012. And I said in April 2009, Wasiu entered into an agreement to sell the product. You know that he cannot sell the product because the product is not ready until 2012. But he anyways entered into an agreement to sell the product to Easy Finance for 6 million. Meaning that Easy Finance will give him 6 million for the product, knowing fully well that if Easy Finance knows that he's not going to get the product until 2012, because the product is not ready until 2012, but the guy is ready to give him money. Now, say the agreement gave Wasiu the right to repurchase the product at any time up to 31st March 2012 at a fixed price of 7.9 million. So saying that Wasiu can buy the product back, the product that did not even go to Easy Finance. But anyways, they say he can buy it back at 7.9, which means that Wasiu would pay him 7.9 at any time up to when the product is ready. At which date Wasiu is expected to now to be able to sell the product for 10 million. See, technically, this is what I've explained to you. Substance, as far as substance is concerned, even though he has entered into an agreement, the substance is that you have not sold, you have not transferred control, you cannot recognize revenue. In fact, the money you collected is a loan. It's a loan because now you have an obligation to deliver 7.9 million. It's a loan. You cannot recognize this as revenue, right? So you see, when the product is actually ready for sale, you can now sell it for 10 million. And the compound interest, the compound interest was you have to pay on the 3-year loan of 6 million is 1.6, 660, 720. Meaning that 6 million that Easy Finance actually gave him, if he had gone out to borrow the money somewhere else, he would be paying interest of 600 in year 1, 660 in year 2, 76 in year 3. And the interest is equivalent to the return required by Easy Finance. Okay, so they want us to prepare an extract of income statement reflecting legal form. So first is legal form now. If I want to prepare an income statement let me see, year end from if the beginning is April 2009, year end will be March 2010. Abi? So sales. Has he made any sales? Based on legal form, yes. Legal form will recognize the sale of 6 million. He will recognize the sale of 6 million. Because as far as legal is concerned, you will say you have sold because you entered into an agreement to sell. So nothing concern legal form about whether you have transferred control or not. So in 2011, in the end of 2011, nothing happened. Okay, before then, was there any cost of sales? Was there any cost of sales? Yes, there was. Because the good cost 5 million. Cost 5 million. So that means there's a profit. There's a profit of 1,000. In the next year, nothing really happened. In the third year, what happened? What did they say? So in the third year, the agreement, it gave him the right to repurchase the product for 7 million, at which time he can sell it for 10 million. So let's assume that happened. So he actually sold and he repurchased for how much? 7,986. 7,986. Yeah. So what's the difference? What's 10 million minus 7,986? So that means the total profit should be around 3,014. That's the total for the 3 years. For this is legal form. So the thing about legal form is that he works with agreements. Whatever is happening on the agreement, he records. So because he has entered into an agreement to sell, so on this date, he recognized revenue, and this is the cost. Secondly, he has also agreed to buy it back. So he purchases it at this and is able to sell it, can sell it at this amount. But when it comes to economic substance doesn't work that way. This is how economic substance work. Number one, as far as substance is concerned, there is no sales in that year. And since there is no sales, we cannot recognize any costs at all because of matching concept. So no profit. So gross profit at that point is 0. Again, in the second year, there is no sales, there's no profit. In the third year, now it is in the third year you can sell based on substance because the product, the product will not be ready for retail until March 2012. That's when it can sell. And how much can it sell? Can sell for 10 million. So this is when we would say he has made revenue. And what's the costs? As far as substance is concerned, the cost is the historical costs, because that's the cost of producing the commodity. It's 5 million. That's the cost of producing the commodity. Okay, so according to substance, our profit is 5,000. But remember that took a loan of 6 million because substance will recognize this 6 million he collected from Easy Finance as loan. And and they told us that ordinarily, if he had taken a loan, these are the interest it pays in each of the years. So we need to recognize finance costs. In year 1, 600. In year 2, 660. In year 3, 726. So this is 600. This 660. And how much is this? 5,000 minus 726. This 4274. 4274. So what's the total? 4274 minus 660 minus 600. Okay. It's not surprising that the total profit is the same for each substance and legal form. So that means the difference is actually the timing of recognition and presentation. So while legal form records at a point in time, a major amount, it records profit in year 1, record profit in year 3, substance records activities that happen over the period. Activities in terms of the fact that it is a loan, you recognize a loan in the same financial position, you're paying interest. And when the activities of control has transferred, has taken place, they also recognize revenue and also the historical cost of that item. That's majorly the difference between the two. Okay, so this is the last question here. Says your assistant has been reading the IASB's framework for the preparation and presentation of financial statements. And as part of the qualitative characteristics of financial statements under the headings of relevance, it notes that the predictive value of information is considered important. Is aware that financial statements are prepared historically after transactions have occurred and offers the view that the predictive value of financial statements would be enhanced if forward-looking information, that is, forecasts, were published rather than backward-looking historical statements. Required by the use of specific examples, provide an explanation to your assistant of how IFRS presentation and disclosure requirements can assist the predictive role of historical prepared financial statements, 6 marks. Okay, so this is another one. So this is asking us that somebody is looking at ISB and he saw that under the conceptual framework, under relevance in chapter 2, they talked about predictive value, which I mentioned. So they are now asking us that by the use of specific examples, provide an explanation on how IFRS presentation and disclosure requirements can assist the predictive role of historical prepared financial statements. Can we speak to this? Have I mentioned anything around this? Have I mentioned anything around this? Okay, so when it comes to predictive role, predictive value, I gave you 3 examples in this class when I was teaching you relevance last week, which I also revised today. I said, number 1, comparative information. The fact that the reports of financial statements are presented for 2 years, that supports a predictive role of that information. Because when you give us a report of last year and this year side by side, that will help us to predict what will happen in the future. Because by the time we look at the current and the future, we can, the last year and this year, we can predict. We can use it to predict. Another one is where we have diluted EPS. IAS 1 and IFRS 18 requires that an entity that is a published, that is a listed company, should present diluted EPS. And diluted EPS means that we are showing you that there are some potential ordinary shares. Some ordinary shares that can become ordinary shares in the future. They are not ordinary shares now, but they can become ordinary shares in the future. And if they become ordinary shares, this is the impact it's going to have on your EPS. And you know that EPS measures the return to shareholders, the earnings shareholders get for each of their shares. So diluted EPS shows the reduction that can happen to that earnings if potential ordinary shares become ordinary shares. That helps with predictive value as well. It helps with predictive value because then user will be able to predict whether they want to exit this company and all of that, depending on the level of dilution in their earnings. Another one is discontinued operations. IFRS 5 requires that if an entity has a segment that it wants to discontinue in the future, it says that the entity must present that segment separately. It must disclose the performance of that segment separately. That also helps with predictive value, because by the time a segment that you are planning to sell, you're already disclosing it separately, then people will be able to see that, this guy is planning to sell a segment, and they can predict, they can make appropriate decision. Not only that, the assets of that segment, you would then call it non-current assets held for sale. Or if they are a group of assets, you call them disposal group. That also helps with predictive value. Also, IS1 and a lot of standard requires that when you have material items, they want you to present it separately. You need to present it separately. When you have material one-off items that do not reoccur, present it separately and disclose it that this item is a one-off item or is an outlier. It's not something that would happen again. You disclose it separately. With that, user will be able to also predict and make informed decision, and on and on. So these are some of your past questions. So I just intentionally want to go through these past questions with you just to show you that we have started. This is a part of your syllabus that they ask every day. It's there, it's always there. It's commonly asked in your exam. And that's how we are going to do. Except for very few of you, I would want the level of your participation to go up. I would want the level of your participation to go up. You have to be actively involved. You have to be actively involved. I'll be asking questions. You guys will not answer. Just be looking at me. Go and read in advance and participate. It has its own value. Don't just, except if you just came here to come and dash us money at equity. Please participate, ask questions, involve. That's why you're here. You're not here to come and watch. It's not a football match. You're here to learn and participate. Okay. So we are done with that. My class 3 with you is going to be ethics, and technology in reporting. So as soon as we finish this, then we would finish our class for this period. Then we'll continue in our next period, where we would look at another topic. So please, let's take, we have done like 1.5 hours doing revision. Let's come back by 3:35. Let's take like a 10-minute break. Okay. So let's proceed with our class. Now, let's look at ethics and technology in business reporting. So this is, in fact, this is an area of your syllabus that a lot of you will just ignore. A lot of you will just ignore it, and we assume that it does not exist, whereas it is the easiest area of your syllabus that you can easily pick points. And it is around almost 15% of your syllabus. And it's so easy for you to pick points in that area, because you find the examiner asking you questions in that area. Is always there, either of the two, ethics, technology. You see that they'll be asking about technology and reporting, they'll be asking about ethics. So let's really talk about them. So let me start with ethics. You see, as accountants, Right now, you guys are still accounting students. In the next 1 year, some of you would have qualified, or in less than 1 year, some of you will qualify by November. While some that are writing piecemeal will eventually qualify. But whether you're an accountant or an accounting student, as you guys are right now, you have certain ethical obligations that you need to fulfill as a member, as a student member of ICAN. And ICAN has professional codes of ethics. And in that professional code of ethics, there are principles, there are fundamental principles that we need to uphold. There are fundamental principles that we need to uphold. And these fundamental principles, you need to understand and digest them and apply them in your daily living right from now. And number one of them is integrity. You expect that you have to be honest and straightforward as an accounting student, or if you eventually become an accountant, as an accountant in business or in practice. You have to be a honest and a straightforward person. When you say A, you should do A. Let your word be your guide. And let your word be your bond. It's very important. Integrity. Number two is objectivity. I'll be teaching you a lot of standards. And we're not just teaching you for fun. We are teaching you so that you will know it, use it to pass your exams, and you also apply it in your workplace. And all these accounting standards are very sensitive in the sense that you have to comply with it. In the sense that you have to comply with them. If you don't comply with them, it becomes an ethical issue. So, to ensure that you comply, it requires you to be objective. So, objectivity means that ensuring that your actions, ensuring that in carrying out bookkeeping, reporting, you carry them out based on the standard, based on fact. When you're talking, you talk based on fact. And don't ever allow undue influence of another person to affect your professional judgment. Don't let a boss, don't let a senior colleague to coerce you into doing the wrong thing. You have to be objective. You should work based on facts. Don't allow anybody influence you to doing the wrong thing. You have to be objective. Work based on documented fact. Another fundamental principle that we need to uphold is professional competence and due care. As an accountant, you need to continually update yourself. You have to be very competent in your work delivery. Anything you do, anywhere you find yourself, any function, any society, any engagement you belong, you have to be competent. And that is where you can show due care. You need to be competent because you would then show due care. You will exercise care and caution. And that is why even when you qualify, you still need ICAN mandate that every member must have at least, I think, around 40 MCP units before you can do anything with them. If you want to get anything, your 40 MCP unit every year must be complete. If it's not completed, you have to go and get it. You will get last year, all the years you have missed, you have to. And getting MCP unit meaning that you need to go for trainings from accredited training centers that are related to ICAN. That is why before you even pass ICAN exams, they would ask you serious questions. And that's why we are teaching you very seriously here. So professional competence and due care. Another one is professional behavior. We expect you to behave right. We expect a situation where people will not ask you that, but you said you are an accountant. But you said you were an accountant. It's different from, are you an accountant? When people look at you and they see that your conduct, your mannerism, the way you dress, I mean, it presents aura of an accountant. You can ask, are you an accountant? That's an honorable question. By the time they're asking, well, you said you're an accountant now. By then they look at the way you're even talking, the way you are dressed. Say, you say you're an accountant. You're not, you don't look like one. Professional behavior. We expect you to conduct yourself in the best possible manner as a professional accountant. Even as an accounting student, now you see on the roadside, now everybody is selling roasted plantain. You can buy a roasted plantain and go and eat in your house, but don't say you're strolling home and you're eating roasted plantain with something like that. You cannot catch you as an accounting student or as a professional accountant dragging or fighting with conductor for change. You cannot be doing all of that. You need to present us in the best possible manner. The way you talk, the way you dress, the way you look as a person, it needs to present that aura of a professional. Our final one is confidentiality. This is very important in the sense that if you have any document or any information that you obtained as a result of your engagement with either your client or your employer, you cannot share that information. You cannot share it. You cannot share that information with another party. So that information are confidential, because if you were not engaged, you will not have been privy to those documents. So how would you then share it to another party? You'll be exposing documents, information, data that you're not supposed to expose. Now, we expect that you follow this strictly, and that is why we need to also bring to your notice what we call threats to fundamental principles. So there are some threats that can affect you, that can distract you from complying with the fundamental principles. And the first of which is the self-interest, the self-interest threats. This relates to where you have financial interests, where your financial interest might be affected as a result of doing the right thing. That if you do the right thing, your financial interest or that of your close or a close member of your family, something like that, might be affected if you do the right thing. All right, maybe probably they want to employ some set of people, and on the basis of the result, from the outcome of, you saw that your person is not going to get in and you're trying to, or you are the accountant of your company and they have a deal that you guys will get a bonus if the company makes, let's say, 10 million naira profits at the end of the year. So you saw that your company has made around 11.5 million profits. And everybody, you're already happy. But suddenly you got a demand notice. Not even a demand notice. You got a notice of refusal to amend from, let's say, FIRS, now NRS, a notice of refusal to amend, which means that they have given you a demand notice before, but you objected to it, and they responded by saying they don't accept your objection, and they are refusing to amend that initial demand notice. When you get such a letter from the revenue authority or the tax authority, you are really required to go and pay that liability, or you go to court. So in such scenarios, IS 37 majorly require that you make a provision, because it then becomes probable that there might be outflow of economic benefits, and the amount can be measured reliably. So in that wise, you make a provision. And when you make that provision, it's going to impact your profit. And the tax liability they brought, it will impact your profit to a level that it will go below the threshold that you guys will use to get a bonus. So what would you do? A lot of us will just keep that demand notice until next year before you release it for anybody to see, just so that you will not record it and everybody gets a bonus. But that's wrong. The right thing is to, because the liability is due within almost 7 days. So you're supposed to disclose, and it is what it is. So that's self-interest threats. The things that might affect your financial interests and or that of your close member of your family. Another one is self-review threats. And these usually arise where you are the preparer of a document and you are also the reviewer of the same document. For example, you prepare a budget for your company and you are a member of the committee that will review that budget. So the threat here is that you might not want to find any faults in what you have done. Even if other people say that there's something wrong here, you would be defensive. That likelihood is there. So there's a threat. There are some people that will handle it properly. So which is why we really need everybody to handle that properly. And the best possible way is to ensure that any document you prepare, you don't be the one reviewing it. Don't even be part of the reviewer. If you have to be, you have to be open-minded. Otherwise, there's a self-review threat, because it's going to affect your objectivity, it will affect your professional competence and due care, which are your fundamental principles. So self-review threats exist where you are the preparer of a document and you are on a seat where it is reviewed as well. You are the one that is reviewing it, or part of the team that is reviewing it. You have advocacy threats. You see, when you advocate for somebody, it means that you're speaking on behalf of that person, and it's usually in a positive light. What you're talking about is positive, is good. So advocacy threats will arise for you as accountant where you present an information for your company, on your company, to a third party. And that information is false. That's an advocacy threat. So when you're writing, when you're speaking about your company, the typical one is responding to regulators. When regulators send you a letter, you know how to respond. And you're now you're defending it with facts that are not true, with wrong figures, with wrong backing, with forged documents, or hiding the truths. That's an advocacy threat. It's an advocacy threat when you're providing misleading information, meaning you're speaking on their behalf, but it's wrong. Or you are asked to come and testify in a court of law, you are there. There's an advocacy threat there. If you're saying the wrong thing, what is not right? Advocacy threat. It can impair your integrity as a person, can impair your professional behavior as a person, that it will it will belittle you as a person. So we need to know that that actually exists. Another one is familiarity trait. You see, as a result of close relationship or long-term association with your colleagues or with people, it can result in oversight, that you overlook a lot of things. It can affect your objectivity, it can affect your competence, it can affect your behavior. Familiarity. So there's a threat in familiarity, whether as colleagues, whereby you are not now unable to separate business from leisure or from relationship. That whatever the counterparty does, you don't find anything wrong there anymore. You just okay it because you guys are now too familiar. Or you are an auditor to your client because you have been auditing this client for a long time, that you guys are now so close that they invite you for their children's birthday party, they invite you for dinner. You are so familiar, and you are the auditor. You will not find fault in their books anymore. You can never qualify their account, even when there are obvious gap, even when there are obvious non-compliance, you would overlook it. Familiarity threat. So familiarity has an inherent threat that we need to be aware of. It will affect your integrity. It will affect your objectivity. It will affect your professional competence and due care. It will affect your professional behavior. Familiarity threats goes all through. Another one is intimidation threats. So this one arises from pressure from an overbearing boss, or boss that always want things to be done their way, or you want job security and you're scared and you don't want to be sacked. For that reason, you're ready to do anything. Anything they ask you to do, you don't care whether it's right or wrong. You just go, you just do it. You don't even think about it. See, that's an intimidation threat. When you're ready to do anything, it's an intimidation threat from your angle and from the perspective of the counterparty that is also presenting you with options of sending you away if you don't do the wrong thing. There's an intimidation threat there. These are the threats to our fundamental principles. Now, how do we safeguard against these threats? Safeguard to threats to fundamental principles. How do you safeguard against this threat? Two things, generally. Number one is for you to speak up, escalate, speak up internally. And number two, escalate externally. In most cases, by the time you speak up internally, it will have resolved the issue. When you have issues around colleagues, boss, and all of that, most companies has internal policy or company's policy for whistleblowing, for speaking up. If you have an overbearing boss that's always threatening you, if you don't do this, if you don't do that, you can do him a letter. Express your opinion about his conduct, about the way he goes about sending you assignments, or the feedback you get when you do your job. Do him an email. Dear sir, I've been working with you guys for 4 years, and I noticed that your approach to requesting for deliverables is harsh and is affecting my mental strength and ability to deliver. I hereby request that you'd find a way to improve on this. Thank you. You present him with a letter and see whether it changes or not. Or you have you are on an audit team with a client that you are so familiar with. Communicate with your boss that they should remove you from that team, that you don't want to be part of that team. Or they are asking you to present a report that will be misleading to users. Tell them that this is wrong, that you cannot do this. Escalate. And you can also escalate externally. A lot of entities also have policy for escalating to regulators, to relevant parties, depending on situations. I mean, there was a bank that somebody went to deposit $9.8 million cash, which is, of course, against the regulations of the land. So one of the AFCC knew, they came, they collected the money. So, and it was because somebody whistleblew, somebody spoke up, somebody escalated externally, as it were. So, this is it about ethics in reporting. Now, let's look at some questions.
Okay, question 1. The directors of Feed.me Limited Group are happy about the results of the year ended December 31st, 2019. In terms of profitability, as the group recorded over 20 million profit during the year, which is an improvement over that of the year 2018. They are of the opinion that the net cash generated from operating activities of the group is likely to be very low. They have subjected that group accountant to find a way treating proceeds from sales of plants and equipment and issue of loan notes as part of cash generated from operating activities, as this would enhance the cash health of the group and to make the shareholders more comfortable at the next annual general meeting. Required, discuss the ethics issues involved on the treatment of proceeds from sales of plants and equipment and the issue of loan notes as suggested to the group accountant, and how he or she should handle the above in line with ICAN Code of Conduct. 5 marks.
Thank you very much, Bidera. So if you look at this question, it says that discuss the ethical issues involved on the treatment of proceeds from sales of plants and equipment and the issue of loan notes as suggested to the group accountant, and how he or she should handle the above in line with ICAN Code of Professional Ethics. So what's the issue here? So again, let me first summarize the way you approach questions like this, because this is how they ask it for all the diets. They will ask you should discuss the ethical issues. So all you just need to do is that you will see the question will be all about somebody's asking you to do the wrong thing. So the ethical issue is one. You're going to identify what is wrong and why it is wrong. What is wrong and why it is wrong. And you're going to tell them that because of this, it's going to affect my fundamental principle of this, like objectivity, integrity. You shall mention what you think it will affect. After you have done that, that will be like your paragraph 1 and 2. After you have done that, you then state the identified threats that this is arising because of these threats and these threats, because they are trying to achieve this and this. Then after you have said something around the threats, then you go to the safeguards, meaning what action should be taken. And this question has even asked that how should you handle this in line with the ICAN code of ethics? Those are the safeguards. And that's how you go about answering question of this nature. And if you look at this, in this case, the issue is that the directors are saying that you should recognize net cash generated, not even this. They are suggesting to the group accountant that you should treat proceeds from sales of plant and equipment and issue of loan notes as part of cash generated from operating activities. They said it would enhance the cash health of the group and make the shareholders more comfortable. This is wrong. Proceeds from sales of plants is not treated in operating activities. They are treated as investing activity, as a negative, as an outflow, as an inflow. And proceeds from issue of loans, when you borrow money, they are also not an operating activities item. They are treated as part of financing activity as an inflow. So in this case, now that they are requiring that you treat it as operating, because treating it as operating will boost their net cash flow from operating activities. And it will show as if the company is doing so well and they are making so much money from operations. And it will then undermine the fact that the company is actually selling some assets. And they are even borrowing money. It will not show those ones at all. So it's wrong. So to answer this, you just need to state the fact first that the directors are requiring that you should treat this as this, this, and this. This is wrong because this is how it should be treated. If you don't know how it should be treated, because some of you might not even know the right way to treat it, don't even go there. Don't mention it if you're not sure. You can just say, okay, this is wrong. And you can say that, and this action, if you do this action or what they're asking you to do is not right because you state the reason. Number one, you can tell them, one, it will mislead the users. So whoever is looking at the information, it will mislead them. Whatever information they take on the basis of that report will be wrong. It will mislead them. Number two, it's a violation of the accounting standard. The way IAS 7 says we should treat this is not what they are saying. It's a violation of the accounting standard and is a serious breach of trust. You are breaching trust, and there could be regulatory sanction if FRCN should find out about how you have treated the item, or they understand the nature of the item, and now they will sanction the company. You state all that, and you say, see, because of this, if I do this, it would be against my fundamental principle of integrity, professional competence and due care, objectivity, and professional behavior. And there is an inherent, you tell them the threat, that there's a self-interest threat here, because the director are trying to look good in front of their shareholders and present the company as if it's doing well. And for you as an accountant, it's an advocacy threat, because I'll be presenting an information that is wrong. It's an advocacy threat. And following from the above, I mean, the actions that should be taken by you, first, you educate the directors, you assume that they don't know, you educate them that, this is not, we cannot treat this thing this way, because if you treat this way, it will be against IAS 7, and IAS 7 says you will tell them, you educate, you speak with them. If they don't listen, go to the audit committee of the board. If those ones don't listen, because that's where it ends for a company, then you can then speak to regulators or a senior colleague, and they will advise you on how you should handle this. And like I told you, companies usually have policy for whistleblowing on how to speak up when they are faced with issues around wrong things, right? So you need to be able to speak up and document all of these processes. And that's how you go about answering a question of this nature. I presented the solution for you just so that you'll be able to read through, and in case they ask similar questions, you can also apply it in similar cases. I have many of those questions here. So this question 2 was about confidentiality, right? A friend of yours is asking you to present him with information about a company you want to buy. That is also not right. You say the reason why it's not right, you state the threat, and you state the actions. And if you look at the way they asked it, they say identify the ethical issues involved in the above scenarios. The same way I've answered. Again, I've given you the solution and just look through it. There's another one here. This one, they said that you should discuss the meaning of an ethical act. You see, when we say unethical act, it's an action by an organization that is morally wrong, either against employees, against the community, against the government. I mean, any financial misconduct, whether they are reducing the liability they are supposed to pay, or, tax disputes, or whether they are creative accounting, or aside financial misconduct, it could be environmental degradation, right? Probably they are not a sustainable company and all of that, or whether they are engaging in child labor. Any action that is not morally right is an unethical act. And again, in this instance, they were also asking this one too, they were asking the accountant to do the wrong thing. They were asking him to understate receivables. So the same manner of, they'll just tell you something is wrong, and they'll ask you, what should the accountant do? So you state what is wrong, why is wrong, the threats, and before what you should do. 5 marks, as you can see. And I gave you the solution there. So I stopped giving you the solution from question 4, but I need you to attempt something. It's the same pattern. Discuss the ethical implication. This one, the director was asking him to recognize a loan, director's loan, as cash. Imagine a director took a loan. You have taken a loan or something that is a liability and is a financial asset for the company. You are saying they should still keep it as cash. Money that you have taken. So, like that. There are a lot of questions here. And yeah. So, even here too, everything is similar. So just please take your time to look at it and see what you can make out of it. Okay, so that's the first part of this class, ethics in reporting. Now, the second part of this class is technology in reporting. Technology in reporting. Okay, I'm back. So let's look at the final part of this class for this period, which is technology in reporting. So you all agree with me that as far as our profession is concerned, technology is evolving, and especially in the areas of artificial intelligence and machine learning. And of course, they are not coming to take over our jobs, but they are going to make our jobs easier, faster, and it will make you accountant, especially you that you're doing a repetitive task that does not even require human intervention that a machine can do. There are some tasks that um, the machine can easily do. So it makes us develop ourselves beyond just number crunching. We focus more on problem solving rather than crunching numbers. There are a lot of work I want to do now in my office. I won't even waste my time. AI does a lot of the analytical and number crunching things. I focus more on the advisory, focus more on the insights. Even though a lot of these AI also can do this, but um, we still do that. These are the areas where we are more efficient than classifying or adding things together and all of that. Technology does that pretty fast. And we want to just talk about that today. I just need you to, the syllabus requires that you know this technology, you know their benefits, and you know the areas in which they can help make our work easier. And when we talk about technology in business reporting, we are saying that the use of digital tools, systems, and applications to collect, process, analyze, and present financial and non-financial information. So the use of digital tools, systems, or applications. So in which areas? What are these digital tools? So I classify these tools into the areas of reporting where they are useful. And the first area is transaction processing and accounting system. So it's part of what we do as accountants. And the areas where these are useful, or the tool that are used for this, the technology tool that we use for this is accounting software. We have Sage, we have QuickBooks, Zero and Tally. I'm not sure whether Tally even still exists, but maybe I know Zero, QuickBooks, Sage, there's Zoho, and there are even ones that are more robust, enterprise resource planning, ERP system, that goes beyond just accounting. They help you in some other, they help you digitalize your end-to-end operations of an organization. ERP system, everything, they digitalize every part of your operations. And the tool, the SAP, Oracle, Microsoft Dynamics, these are ERP system. There are a lot of payroll systems, many of them out there, that they can help you process your payroll within seconds. And with these digital tax reforms, you'll be seeing tools that can easily help you file your returns, do your NHF, do your pension, do all that very fast. There are tools for inventory management systems, and almost all supermarkets have a POS system in front of the cashier or the person the attendant that would collect money from you. So as far as transaction processing and accounting system is concerned, this is an area of accounting that technology will help us improve. And these are the tools that can be used in that area. They can ask this, they have asked it in your exam, not that they can. and it's something they can ask again because we need you to know this. Also, another area is data management and storage. Accountants store a lot of data. We have a lot of invoices. We have a lot of payment vouchers. If you get to some offices, if you look at where they keep their files, you will run back first. It's a gigantic whole place. They have huge files. No, the technology has evolved beyond that. That you might not even need to print a single piece of paper. There are databases. You need to know about SQL database, Oracle database that you can use to store any quantum of data, right? And they can also serve as data warehouses. And beyond that, there are cloud storage platforms now. Me, I use OneDrive for all my documents. Even if I have videos, it's secured for life. Just that you pay every year, though. If you don't have so much data, you can use Google Drive. Google Drive gives you 15 gig free for life. So if you don't finish it, if you finish it, they will then ask you to subscribe for yearly subscription or monthly subscription, depending on which one you want to key into. So those are data. So technology can help in that space. Another thing accountants do is data analytics and business intelligence. We do a lot of analysis. And the common one that we all know is Excel. Excel does it a lot for us. So it's also a tool. There are other tools like Power BI, Tableau, ClickView, and other statistical and analytical tools, right? These are areas that these tools with areas that can be digitalized, that technology has helped us innovate. There are also AI, artificial and automation tools, in the sense that most of these tools for data analytics, data management, transaction processing, they are mostly AI powered. They are machine learning applications. Most of them they have integrated artificial intelligence. And it is now artificial intelligence that is now making this software, even them too, they are now going just beyond number crunching, in the sense that if you give them historical data, they can predict, they can give you insight, they can analyze, they can do a lot more work before that requires human intervention. Now they can do it. They can reason. They would reason. They would chat with you. They would talk to you as if you're talking to an intelligent being. So most of these tools are already AI powered. Another area is reporting and presentation. Whether you want to do, and the popular one for presentation is PowerPoint that we all know. But there are other dashboard and visualization tools or financial reporting software that can help us with our presentation. Or there are some interactive online reporting portals. There are a lot of softwares out there that does all of this, but it's an area that technology has also taken over, financial reporting and presentation. And also there are some non-financial and ESG reporting systems. Like during the week, I'll be inviting you for a class on sustainability reporting. And in this area, you find out that technology can also help to prepare these reports. Prepare these reports on sustainability reports, help us prepare reports around carbon tracking, whether you want to track your impact on the environment, you want to track your emission and all that. Also, there are health and safety reporting tools. So non-financial information reporting system are not left out. Also, communication and collaboration systems or platforms like email. Some companies have intranets where they can communicate within the organization. There are cloud-based collaboration tools, investor relations tools. So even audit. So these are areas that technology has distorted. Not distorted, they have disrupted it, they have evolved it, they have improved it, and we cannot be left out. So from these tools, I also need you to also be aware about the roles of technology in business reporting. You will see that number one is automation of data collection and processing. All of these tools has automated data collection and it has automated it. If you want to enter sales, for example, on QuickBooks, the best you need to do is just to click on a button. It brings out a dialog box, a form. Just fill the form. You click enter, and that's it. It does the remaining for you. From there on there, you can go to report. It brings your P&L, it brings your statement of financial position, it impacts your inventory, everything. It does everything. It has automated data collection. In fact, most of these software, you don't even need double debit and credit. You don't need to know debit and credit to use them. And it works perfectly well. Then the accuracy and reliability improved because they are automated. It's AI doing it. It's software doing it. It's accurate and it's reliable. There won't be need for validation checks and all of that because it's already validated. Again, it's fast, it's timely, and it's real time. It does it fast and is real time, instant. Especially if it is cloud. If you are putting it on cloud, as soon as you enter it, anyone can view it anywhere in the world. And also it enhances data analysis and decision making. And there is now integration of financial and non-financial because non-financial are also disrupted with this technology. So it's easy to then present financial and non-financial reporting into a single reporting framework. You can easily do that. And transparency and stakeholder communication becomes improved because this technology is digital. Anybody can log on and see it. So communication becomes improved and it strengthens internal control because you can't keep anything anymore. Is how anybody can check. Everybody's logging in. It's not manual that you'll be writing and changing some things, or you'll be keeping some documents that you don't want people to see. It's not possible with digitalization. And it can be cheap because manual processes, rework has been eliminated. It's cheap to incorporate these accounting softwares and this other technology, and it supports forecasting and future-oriented reporting like that. So majorly, this is the most useful part of your exam, knowing about the areas that has been disrupted that can be disrupted by technology and the tools themselves, and also the importance of technology in business reporting. Now, there are some tools that I need you to know that are recent. I just need you to be aware of it. And one of it is distributed ledger technology, right? Distributed ledger technology. So there's a technology called distributed ledger. So it's new. And this technology, it works based on a decentralized digital system. And this system, any records that is transferred into this system is shared and it can be viewed by everybody. Everybody, as soon as you put a record on that system, everybody is seeing it. And it's not like it's one person. No person is controlling it. Is a distributed system. Is generally controlled. No single person is controlling it. And whatever transaction you put there is secured, is time-stamped, and is immutable. Immutable means that it cannot be changed. It cannot be changed. That's distributed ledger technology. So what I need you to remember about this technology is the fact that when you put a record there, everybody sees it. It's different from our QuickBooks Sage, our ARP that we work now. That is only our people in our company that can see it, or some people that have access to our system, our own system. But with the distributed ledger technology, it's not about your own, it's everybody's system. It's everybody's system. So when you enter a transaction, everybody sees it. I mean, it has to be public transaction relating to your company. So why the adoption is slow is, I mean, companies are looking at, especially those that are not listed company, they are looking at issues around privacy, data privacy, and confidentiality. So it's slowing down the adoption to a large extent, but it makes transactions very fast, open, secured, and it's fast tracks a lot of things. And it is based on this technology that blockchain was developed. Blockchain is the most common form of distributed ledger technology, blockchain technology. So, and they have asked you guys about blockchain technology severally. Is developed on distributed ledger technology. So it works by making sure everybody have access to the system and can see what is happening. When you enter transactions, you cannot remove it. It is immutable. Everybody is in charge. No single central authority. Okay. And aside blockchain, there's smart contracts. Is also another technology that helps you execute contracts. As soon as everybody consents, is executed. We also have cryptography and digital signatures that as soon as you just consent, it puts in your signature. There's a consensus mechanism and tokenization systems, right? But the most popular one we see them asking is blockchain. And when it comes to blockchain, we are talking about, we are really talking about it ensures blockchain or distributed ledger technology. It enhances real-time reporting, improve data integrity and reliability. There's audit trail and transparency. There's automation through smart contracts. It improves reporting of complex transactions, integrate financial and non-financial. And I put in some benefits to business reporting and also the risk involved. Like I told you, the fact that there is no single central authority, it poses regulatory and accounting uncertainty. There's this data privacy and confidentiality concern. And also to implement a distributed ledger technology is costly. It's costly because a lot of people are involved. A lot of people are seeing it at the same time. So the computing power it requires is huge. It requires huge computing power. There's also, yeah, so those are the major risks. And just to put context to what I'm talking about, the way blockchain technology works or distributed ledger system, the way it works is if you want to enter a sales transaction, for example, based on our traditional system now, let's say your company is ZAM, your company records it in the accounting system, okay? Every other related party, like your customer, suppliers, your auditor, they can't see it. They will rely on your record. If they need it, they will ask of you, and you can manipulate it if you wish. Okay? Except if they detect it later. But with a distributed ledger system, Every sale that is recorded on the shared digital ledger immediately is accessible to everybody. And it is immutable. Of course, they cannot adjust, remove, or edit, but it's accessible to everybody. That's the context of a distributed ledger system like that. And it can work for transaction processing, it can work for data management, it can work for data analytics, it can work for reporting. All of our accounting records can be there, whether inventory records, whether fixed asset register, whether sales record, purchases records, shareholders register, anything you want to, is secured. Secured. I can ask you all of these. These are you go and check your past questions. These are the simple questions you majorly find in your exam. And I gave some other scenarios that you can actually look at. Aside distributed ledger, there is cloud computing. Indirectly, we have mentioned cloud computing, right? Most of these accounting softwares I mentioned, most of these ERP software we have mentioned, most of these payroll system we have mentioned earlier on, they are now cloud-based. They don't, gone are the days where you have to download the desktop app on your laptop before you can. No, all you just need to do is just to log in, sign up, then you can work. So that's cloud computing. Is now internet-based saver. Internet-based, they now have the use of internet-based server to store data and run applications and process information. So you don't need on-premise computers or server or server. It's cloud-based. You just need to log on to a website and you do your work. So in fact, now we have QuickBooks Online, SAP, ALP, Google Drive, all of them are online now. They are all on the cloud. Even our darling Excel is online now. You don't have to download Excel on your laptop. You can use it online, right? So cloud computing. So I have the benefits here: cost savings, scalability, real-time data backup, transparency, like that. And there are there's a risk of data security dependent, because you have to depend on the service provider. You cannot build this thing yourself. You can, but it's expensive. So confidentiality, regulatory compliance issues, and all of that. Okay. And there's also artificial intelligence. We have mentioned this also. The reality is that AI already supports a lot of our data collection, processing, analysis, and presentation softwares already. So AI is inbuilt in them. And what is special, I just need you to understand that something called AI that is so smart. It can learn from data, it can recognize patterns, make predictions, perform tasks that normally require human judgment. Now, can do it without your interaction. If you give an AI a trial balance, it can draw up accounts for you, can draw up disclosure requirements for you. If you make mistakes, just that the thing is you cannot 100% rely on them now, but it can make your work fast. It will give you the initial one. Then you can just review. If there's any mistake, you can ask him to update it or you correct it. But at that point, your work is fast. So a lot of the computing, a lot of the analysis that's done it for you. Something that will take you hours, it does it within seconds. Then you can focus on insights rather than adding one and two together when computer will do it within seconds, which is why we are talking about this, which is why you find ICAN asking you about it every night. We need to be sure that you understand the fact that AI is real, is out there to make your work very fast. And I gave example of some tools and all of that. Most of the tools I mentioned earlier on, AI is already embedded in them. So I gave some benefits and some ethical challenges I need you to learn. Similar to AI is machine learning. So I didn't say much on this because machine learning is a subset of AI. It's very similar to it. So it also learns from data. It also identify patterns and all of that. And it can be used in business reporting as well. So that's pretty it around technology in reporting. So they asked it, so well, look at this type of question now that they asked. They said that you are the CFO of Favor PLC. He noted that the record of Blessing Limited and Grace are maintained using blockchain technology required. Discuss the types of records that a company can maintain in blockchain and state two benefits of making use of this technology. Look at it, 10 marks. 10. You can get 10 over 10 easily because just don't restrict yourself because any type of record that you can think of, you don't have to follow this my line of solution. You can, whether your sales records to capture your list of invoices, your customer records to help you capture your list of customers. Can help you record your fixed assets, can keep track of your contracts, your shareholders register, any record that you have, or any type of ledger. Just keep mentioning records for them that we maintain in accounting normally. Your payroll records. It can help you do your tax records. You can document all of that. And they now ask for the benefits. So you need to learn the fact that, and I gave you some of the benefits up there as well. It's very secured right now and it's immutable and it makes your work is transparent and open. It enhances communication and all that. So I put the solution for you to be able to look at it. And there are also some other questions here. This one asks about identify and explain the various ways in which finance executive can embrace digital transformation. This one will go into those tools that I mentioned earlier. I mentioned the areas in which technology can help. I talked about transaction processing and recording, or transaction recording and processing. I talked about reporting and presentation. I talked about auditing. I talked about financial and non-financial part and ESG reporting. And those other areas, data management and storage, data analysis and business intelligence. These are areas, and I even mentioned additional areas in which finance executives can embrace digital transformation. So yeah, my solution is a guide, but just try and understand and be ready to um, to evolve yourself, right? And be able to just see something in the exam. So, and how many marks are they giving that diet? Another 10 marks. So I can confidently say that this is a 10% part of your syllabus. It's there in most of the diets. You'll find it there. So just take your time I'll share this note with you. Keep it in a very important place. Look at your past questions, solve past questions. So we have done one of the most important topic today, most important topic in your syllabus, almost 15% or 20% of your syllabus. Ethics in reporting and technology in reporting. So revise it and make sure you take care of it. So in our next class, that is also happening sometimes later today, we are also going to be looking at another very important topic, which is ratio analysis. I'll be looking at analysis and interpretation of financial statements, which I would teach you all the intro today. Then next week, Sunday, we are going to be solving questions. As soon as I'm done with solving questions, I would also move to earnings per share. I will deal with that as well. Then I know that with that, and also I'm going to invite you for a class on, I think, Wednesday. I would advise you to join. I want to use the opportunity to teach you sustainability reporting. And maybe IFRS 18, I'm not sure, but I am sure of sustainability reporting that I would start and finish that day. And if I have the time permit, I'll also look at some other parts. So if I cover that, the reality is that we have covered like 35% of your syllabus with all that. So by next weekend, I will have finished like 35% of your syllabus. And you find out that students don't focus on these areas. And you can easily walk away with 25 marks because it comes out every day. Ratio, this technology in reporting, ethics, and these other regulatory framework, conceptual framework, they are very important. So when I'm done with that, the remaining 65%, those are accounting standards and group accounts. That is what is left. Then we're going to face those ones and tackle them as they should. Okay, let me allow you guys. Thank you very much. I'll see you in the next class. Have a wonderful time. Bye.
Yes, sir.